Hi, I'm Alan Baker,
And I'm Priya Singleton.
and we are part of Blue's Quality Control team. Welcome to our second video on the Revenue Recognition Standard, or Accounting Standards Codification, ASC Topic 606, as it's commonly referred to. In our last video, we provided you with an overview of the five-step revenue model. If you haven't watched that video already, we recommend doing so to get a broad understanding of the key considerations under each of the five steps. Today, we want to discuss the impact of 606 specifically on healthcare organizations. Priya, before we get into some of the specifics, do you want to remind viewers on the effective date, scope, and transition options of the new standard?
Sure, Alan. The standard is basically effective now. We have a few healthcare clients that have bond financing, which is actively traded, and for these public business entities, the standard was effective for annual reporting periods beginning after December 15, 2017, or your 2018 calendar year. For all other entities, the standard is going to be effective for fiscal years beginning after December 15, 2018, or the 2019 calendar year. We've implemented this standard with a few of our public healthcare clients for the 2018 calendar year, so we certainly want to talk about some of those lessons learned from that process. Also, just a reminder on the scope of ASC 606. The new guidance applies to all contracts with customers, except for contracts that are within the scope of other standards. For example, as you can see on this slide here, leases, insurance, and financial instruments and guarantees, and certain non-monetary exchanges are scoped out of 606. Now, one thing I want to point here is related to the insurance contracts. This exception only applies to insurance entities that are within the scope of Topic 944. So for healthcare entities that fall under Topic 954, that's going to be within the scope of 606. So that is, an entity may have insurance-related revenue, and if you're a healthcare entity under Topic 954, then you're going to be within the scope of this new revenue standard. In addition, the non-reciprocal or non-exchange transactions and collaborative arrangements are also scoped out of 606. There is another standard that the FASB issued, which is ASU 2018-08, that provides specific criteria to determine whether things like contributions and grants are reciprocal or non-reciprocal transactions.
Also, keep in mind that this new guidance is not going to apply to governmental hospitals which follow the GASB guidance. GASB is currently taking a look at the performance obligation concept as part of its own revenue and expense recognition project. So some changes may be forthcoming from GASB in the future, but for this presentation, we're only talking about those healthcare entities that follow FASB requirements that are in the scope of this standard.
Good point, Alan. The standard also provides two transition options when initially adopting the standard. One is full retrospective approach, where you restate the prior year financial statement balances. So if you're a 12/31/2018 year end, it'll look like you adopted the standard in the beginning of the first period presented in the financial statement, which would be 1/1/2017. Second is the modified retrospective method, where you would be adopting in the beginning of the period of adoption. So again, in our 12/31/2018 example, you would adopt 606 as of 1/1/2018, and you would not restate the 2017 balances. Also important to note here is that there are different practical expedients provided in the standard under each approach. From what we're seeing to date, most healthcare entities are electing the modified retrospective approach.
We will cover many topics today and the key concepts from the new guidance. But just to put this into perspective, based on what we've seen in the SEC environment, we don't expect that the standard will have a huge impact on the revenue number in the healthcare industry. There are a couple things from the disclosure standpoint that will be significantly different, but from an accounting number standpoint, generally speaking, we don't expect this will change the numbers materially. But the way you get there will be quite different. Please keep this in mind as we discuss the various issues today.
Yes, Alan, that's very true. And like we discussed in our first video, this standard is a principle-based standard rather than a rule-based standard. So obviously there's going to be a lot more judgment involved, and we'll certainly talk about those areas where our client will need to use more judgment. Given the shift to a principle-based approach, when this new standard came out, naturally many organizations were looking for industry-specific questions on how to apply 606. So the AICPA stepped in and they formed a revenue recognition task force for the major industry groups to really start with the implementation. So throughout our conversation today, we'll talk about specific areas identified by the AICPA Healthcare Task Force, as well as lessons that we learned from our clients' implementations of the standard in the hopes that it'll help you with implementation in your organization. With that, Alan, do you want to kick off our discussion and talk about some of the more significant challenges in implementing the standard?
Sure, Priya. We're not necessarily going to go step by step in the revenue model, but rather focus our discussion on those areas that we think have an impact. We are excited to have with us today Peter Shostak. Peter is a senior manager from our Indy office and primarily serves the healthcare sector. He brings a lot of expertise in this area. Peter, good to have you here.
Thanks, Alan. Good to be here.
So we're actually going to start with step one of the revenue model. In step one, first we identify if we have a contract with a customer. Under the new guidance, a contract is defined as an agreement between two or more parties that creates enforceable rights and obligations. And the 5 thresholds as shown in this slide here need to be met in order for a valid contract to exist. So Peter, what would a contract as defined in 606 look like in a healthcare setting?
So in a healthcare setting, a lot of times hospitals sign contracts with payer organizations, but it's been clarified that the contract in the context of 606 is typically with the patient, as that is ultimately with whom the performance obligation is with. Contracts can be written. An example of a written contract would typically be the patient signs a consent form that shows the rights and the payment terms. However, in situations where the patient is unable or unwilling to sign a form, entities need to determine if there's been an oral or implied contract based on their customary business practice. An example of an implied contract would be when the patient shows up at the emergency room in an incapacitated state and the healthcare entity has a policy to treat patients or is required by law to treat patients prior to a consent form being signed. Or another example could be where a patient calls in advance and schedules a procedure to be performed.
So it looks like there is guidance here in determining whether a contract exists, and ultimately it is determining whether and when an agreement with a patient creates a legally enforceable rights and obligations.
Another area to consider under step 1 is the collectability criteria. Under the revenue model, it must be probable that the entity will collect substantially all of the consideration to which it is entitled in exchange for goods and services that will be transferred to the patient. While the concept of collectability is not necessarily something new to the industry, the standard does require that certain criteria around collectability be met in order to recognize revenue. Peter, how can entities determine if they have met the collectability criteria?
In determining whether the collectability criteria is met, healthcare organizations can look to past experience to determine if collectability is probable. For example, when you have a patient that is classified as Medicaid pending at the date of service or discharge, it's often not possible to determine at that point whether the patient is approved or denied. So in these cases, entities cannot conclude on collectability. But a lot of our clients have determined that they can estimate collectability by looking at past experience as it relates to collections with these patients or a similar class of patients and concluding that the criteria is met. The standard allows for healthcare entities to assess collectability using a portfolio approach. So past experience using various payer types can be used to determine collectability.
So it's really important that organizations revisit the concept of collectability. If you conclude that it is not probable you'll collect, there is no contract and revenue recognition is prohibited under this new model.
This also leads us to the next area to consider, which is step 3 of the revenue model. It requires that entities determine the transaction price for the contract. As a reminder, the transaction price, not gross charge, is the amount that the entity expects to be entitled for fulfilling its obligation to transfer the promised goods or services to a customer. The transaction price is the amount that will ultimately be recognized as revenue. Again, we don't think this is something new for healthcare organizations. Our clients already analyze things like bad debt and contractual allowance when they're recognizing revenue. But there are some specific criteria under 606 that must be met. So we'll want to take a closer look at that. As you can see here on the slide, several things affect the transaction price. We will be discussing 3 main areas today that widely impact healthcare entities, which are the explicit and implicit price concessions, variable consideration, and this concept of constraint. Let's start with price concessions. Priya, can you talk about what we mean here when we refer to price concessions?
Sure, Alan. Let's define what an explicit and implicit price concession is. Under the new standards, the amount that the entity is willing to forego is referred to as price concessions. There are explicit price concessions, which are stated or written in the contract, or a published policy to accept something less than the stated price. So the most common example in the healthcare industry is what we call contractual allowances or adjustments with third-party payers. Another example would be self-pay or prompt pay discounts, where an entity provides a certain percentage of discount immediately, or if payment is made with a certain time frame. And then you have implicit price concessions, which are going to be those charges that you're willing to forgo. Peter, what should entities be considering when determining implicit price concessions?
When determining whether an implicit price concession is provided, an entity should consider whether it has a customary business practice of not performing a credit assessment prior to providing those services, and whether it continues to provide services to the patient even when the historical experience indicates that the entity will not collect substantially all of the discounted charges. If one of these factors are present, a healthcare entity has implicitly provided a price concession to the patient or patients in the patient class, even if it will continue to attempt to collect the full amount of discounted charges. This is very typical in a hospital setting. These implicit price concessions are what we consider to be bad debt if an organization did not evaluate collectability before providing services. For example, treating patients that come to the ER.
So to emphasize, Peter, this is where one of the most significant changes is coming with the standard, right? Historically, we have presented patient revenue gross and only netting the contractual allowances and separately presenting a provision for bad debt. Going forward, you're going to take the total revenue amount and then net the total explicit and implicit price concessions before recording revenue in the financial statement. We need to determine all of these price concessions at the date of providing the service.
Yes, that will be the significant presentation change. Let's walk through a typical scenario. Say, for example, a hospital provides medical services to an uninsured patient in the ER, as is their customary business practice. The standard charges for services provided to the patient are $40,000. The hospital determines the patient here qualifies for their uninsured policy discount and grants the patient a 75% discount. So here in the example, you have an explicit price concession of $30,000 and the net discounted charge is $10,000, which is the amount the hospital intends to collect. However, based on its experience with similar patients, the hospital only expects to collect $1,000 ultimately from the patient. In this fact pattern, the total transaction price is only the $1,000 after taking into account both the explicit price concession of $30,000 and the implicit price concession of $9,000. Historically, you would have shown the full $10,000 as net patient revenue and separately shown the $9,000 as bad debt, but going forward, the net patient revenue would only be the $1,000. Keep in mind that the net amount of revenue is the same under Legacy and New GAAP. It's just how the presentation varies.
So Peter, one question that our viewers may be asking, and one that often comes up, is whether there will be any bad debt at all going forward.
Well, it really depends. If we are not assessing credit risk using the portfolio approach and our actual write-off experiences is materially consistent with our history, then no, we will not have any bad debt. If we are assessing credit risk and expect to collect substantially all of the discounted charges and then later determine that the patient cannot pay, that would be classified as true bad debt. For example, say a hospital provides services to a private pay patient for cosmetic surgery and the hospital's standard rate for the service is $50,000. The hospital evaluates the patient's creditworthiness and concludes that it will substantially collect all of the $50,000 from the patient, but based on historical experience concludes that only 2% of similar private pay patients will not pay. In this example, the hospital will record the $50,000 as revenue and assess this receivable for impairment and record any bad debt accordingly. Recognition of bad debt expense is appropriate when there is no implicit price concession. For example, an implicit price concession may not exist based on the fact that the entity is not required to accept the patient and the entity has determined that the collection of substantially all of the consideration is probable. Therefore, any amounts not collected is due to credit risk that was present in patient contracts.
So for most of our hospitals, they provide the service before they determine whether the patient is able to pay. In those situations, we wouldn't expect a lot of bad debt. In summary then, overall, we will see a significant decrease in the provision for bad debt, and we expect any bad debt to be insignificant and presented within operating expense. Healthcare entities will need to carefully evaluate all facts and circumstances known at contract inception, as well as any subsequent events that may affect a patient's ability and intent to distinguish between change in the estimate of transaction price and impairment loss, i.e. bad debt. Entities should develop and consistently apply clear policies and procedures to perform this evaluation.
Yes, and also something for organizations to think about is the aging approach that they may have historically used to estimate the bad debt calculation may no longer be appropriate under the standard. For those that continue to use an aging component in their bad debt allowance model, healthcare entities should look at actual payment experience to determine that any aging components properly reflect actual experience. If differences are material, the model should be updated.
Great point, Peter. What about charity care? How does 606 impact how charity care is recognized and reported?
Charity care would still not qualify for revenue recognition. However, distinguishing charity care from implicit price concessions and bad debt expense is going to require judgment. Healthcare entities are still required to make disclosures about charity care and may continue to elect to use a ratio of cost to gross charges to estimate the cost of charity care.
When we estimate the implicit and explicit price concession in order to record revenue, the standard does say that we are required to reassess and update that transaction price for these variable considerations at each reporting period. So if a healthcare entity subsequently determines that the amount it expects to collect from a patient is less than what it originally estimated, it'll generally account for the change as a decrease in the estimate of the transaction price, meaning it'll record an adjustment to revenue unless there is a patient-specific event that is known to the entity that suggests that the patient no longer has the ability or the intent to pay the amount that's due. And therefore, the changes in its estimate of variable consideration would better represent an impairment or a bad debt in that instance. And if an entity experiences subsequent adjustments that result in decreases to patient revenue, they should really reassess whether its estimation process is appropriate. Peter, can you give a possible scenario where a change in circumstance would cause an adjustment to revenue versus a true bad debt?
Yes, Priya. Let's assume that we're a hospital in a small town and are not assessing credit risk. History shows us that we receive approximately 10% of self-pay charges, and we use the portfolio approach. The largest employer in town goes bankrupt, many people lose their jobs, and subsequent collections amount to only 2% of self-pay charges. In this instance, the 8% difference would probably be material to the financial statements and would therefore be considered true bad debt. The 90% of write-offs would continue to be classified as an implicit price concession.
Thanks, Peter. That makes a lot of sense.
Another area that the standard talks about is the use of the portfolio approach, especially in the healthcare industry. It is nearly impossible to go contract by contract, in this case on a patient-by-patient basis, to determine transaction price. Thus, ASC 606 allows for a practical expedient to use the portfolio approach. Again, this is not necessarily new. I think a lot of our clients typically look at a grouping of accounts to determine the allowances, but the concept of the portfolio is different from what we've seen before. Let's talk a little bit about how and when a portfolio approach can be utilized. Entities can apply ASC 606 to a portfolio of contracts or performance obligations with similar characteristics. However, the financial statement effects of using the portfolio approach should not materially differ from applying the standard on a contract-by-contract basis. The standard does allow an entity to use the portfolio approach to all aspects of the revenue model or just certain steps. So for example, a hospital may use the portfolio approach when assessing collectability and when determining about transaction price. It doesn't require that you use the portfolio approach, but certainly gives you the flexibility to do so. In establishing those portfolios, healthcare entities will need to use some judgment in determining the number and the composition of the portfolios. Some of the common ways to apply the portfolios would be payer classes, for example, insurance, governmental programs, self-pay or by type of service, inpatient, outpatient, skilled nursing, home health, ER, physician practice would be just a few examples. Peter, what are some of the other aspects of this portfolio approach our viewers should consider when implementing the standard?
One area where some entities may want to take a closer look would be when estimating your implicit price concessions. If you think about your current bad debt allowance model, generally you break it down by payer or service type, then apply a percentage to each category. But the question to think about is whether you need to be going down to a lower level of grouping when estimating your price concessions. For example, when you think about service type, one area where an entity may spend additional time in their breakouts is in the area of outpatient services. Collectability may look very different for an ER patient versus an elective or recurring outpatient service. Another area to think about is when considering payer type, specifically self-pay, and whether the collection pattern really differs within this grouping depending on whether you have a self-pay after insurance patient versus a true self-pay patient. You may even need to go further. For example, if your collections are different for a patient with high deductible plans versus low deductible plans, you may want to consider a more detailed breakout.
That's a great point, Peter. This also leads into another question that we get from clients often, and that is with the changes that are coming with the implementation of this standard, will they need new systems to capture information, or will their general ledger change? Can you give us some insight on that?
Sure, Priya. When I think about the changes, I'd say entities really need to consider how they're going to capture the implicit price concessions that I mentioned earlier, and really consider the need to have different write-off codes to capture implicit price concessions through portfolio analysis. So like I mentioned before, if the hospital doesn't already break out self-pay after insurance in their self-pay model, now is the time to consider whether this change should be made. So I don't think that the systems itself really need to change. It's more a model for estimating your price concessions. As far as the general ledger, I don't foresee any changes there. You're still going to have all the details on the implicit and explicit price concessions captured in the GL for cost reporting or IRS reporting purposes.
Another question that comes up is whether the timing of revenue recognition will really change with 606. And we don't think the timing will necessarily change. The focus is recording revenue as performance obligations are satisfied. And we don't see this as being very different than before, where healthcare entities typically recognized revenue as the services perform. So we expect revenue to be recognized as the performance obligations are satisfied. Of course, there are going to be certain times where revenue is recognized at a point in time or point of sale, such as pharmaceutical items.
Let's chat a little bit about third-party settlements. In the healthcare industry, the amount of revenue earned under arrangements with governmental programs, for example, Medicare or Medicaid, is determined under complex rules and regulations that subject the healthcare entity to potential retrospective adjustments in future years. So several years may elapse before all the potential adjustments related to a particular fiscal year are known, or before the amount of revenue to which the healthcare entity is entitled to is really known with certainty. As a result, revenue from contracts with patients that are paid by these governmental payers typically contain a variable element that requires the healthcare providers to estimate the cash flows ultimately expected to be received for services performed. Entities must include estimate of this variable consideration using either the expected value or the most likely amount method as defined in the standard. The expected value method estimates variable consideration based on the range of possible outcomes and the probabilities of each outcome. This method might be most appropriate when an entity has a large number of contracts with similar characteristics. This is because the entity will likely have better information about the probabilities of various outcomes when there are a large number of similar transactions. Now, on the other hand, the most likely amount is used when there is a single most likely amount in a range of possible consideration amounts. This method might be most appropriate when the entity receives only one or two possible amounts. It's not a free choice, rather it is which method fits best. Keep in mind that the new standards require that variable consideration be considered in the transaction price, but only include variable consideration to the extent that it is probable that a significant reversal of revenue will not occur when the uncertainty is eventually resolved. Some of the industry-specific factors to consider will include whether the amount of the consideration from patients with self-pay balances is highly susceptible to factors outside of the entity's influence. For example, here, a healthcare entity may consider the current economic conditions in the market that it serves. 2, the entity's experience with similar types of contracts. For example, a healthcare entity may consider the extent of its experience with similar patients or portfolio of similar patients. 3, how long the period is until the uncertainty is ultimately resolved. For example, a healthcare entity may consider how long it generally takes to collect the consideration from similar patients. 4, its practice of offering price concessions or changing payment terms. For example, an entity may adjust the standard charges based on its uninsured discount or prompt pay discount policies. And 5, the number of possible consideration amounts. For example, a hospital may consider the historical range of collection history with similar patients and whether the range is broad, that is, there are significant differences from reporting period to reporting period, or narrow, which meaning there's insignificant differences from reporting period to reporting period.
Now, let's briefly talk about continuing care retirement communities, or CCRCs, and some of the specific 606 implications for these entities. When we consider step 1, typically in a CCRC setting, each resident signs a resident agreement, which is an agreement between the resident and the CCRC. The resident agreement essentially serves as the contract and clearly lays out the payment terms. Based on the nature of these agreements, it would qualify as a contract under 606. Also, collectability is still required to be assessed, but given the initial screening process here, it's generally not an issue.
Yes, and typically under a Type A contract, there is the entrance fee, which can be either refundable or non-refundable, and a monthly fee that is charged to the resident. Under these arrangements, the resident has the right to move out and discontinue paying the monthly fee anytime, and what they essentially forfeit is the non-refundable entrance fees, or at least a portion of that fee. Because the resident has the ability to move out and discontinue their monthly rent at any time, the resident agreement is generally considered a monthly contract with an option to renew.
So Peter, when we go to step 2 then and identify the performance obligations, essentially the performance obligation in this contract is the monthly service that the CCRC provides for the residents for continuing to live in the CCRC. So basically all the services that are going to be included as part of the monthly service fee. Whatever they provide beyond that on a monthly basis, or what is not included in that monthly fee, would essentially be a separate performance obligations. Peter, how are the non-refundable fees treated?
Under 606, if in the contract an entity grants a customer the option to acquire additional goods and services, that option is a performance obligation if the option provides a material right that the customer would not receive without entering into the contract. The non-refundable fees contain a material right as the resident is paying in advance for future goods and services, so that may give rise to another performance obligation in the contract. Non-refundable entrance fees that contain a material right associated with the access to future services should be allocated to future periods covering the resident's life expectancy.
So when we think about what is included in the transaction price for these contracts, it will include a monthly fee and any non-refundable entrance fee. Any refundable fees would not be included in the transaction price. We'd recognize these refundable fees as a liability since the CCRC expects to refund some or of all of that consideration to the resident when the agreement is terminated. Thus, the CCRC is not entitled to it. In instances where the refundable fees are only refundable for a certain period of time, for example, a $50,000 entrance fee where the refund decreases $10,000 per year until fully non-refundable in year 5, CCRCs would use the best estimate of the amount of the refundable advance fees in these instances. Conversely, the portion that the CCRC expects to be refundable on a decreasing basis for a fixed period of time until it becomes non-refundable would be amortized over the estimated life expectancy of the resident. Another point to consider when determining the transaction price is the impact of any significant financing component provided to either party in these contracts. What we mean here is whether you need to adjust the payments for the time value of money given the long-term duration of these contracts. The significant financing component can be either explicitly stated in the contract or implied. Keep in mind that the refundable fees are not part of the transaction price and thus do not need to be considered in the significant financing component analysis.
And finally, in step 5, when recognizing revenue, CCRCs would generally recognize the monthly fees when the services for the month are performed, that is, as it satisfies those performance obligations. The non-refundable fees received up front that contain a material right also needs to be allocated. These can either be on a time-based measure, which would generally be a straight line allocation over the life of the resident, or it can be based on when the future estimated costs or services that are transferred to the resident. For example, you could use a cost-to-cost method where you allocate less revenue to independent living and more revenue would be recognized in healthcare.
The last section we want to touch on is the disclosure requirements. Overall, the requirement is that your disclosure helps the user to understand the nature, timing, and uncertainty of the revenue and cash flows. In order to accomplish this, the standard requires disclosure on the disaggregation of revenue. Keep in mind the standard does not prescribe a certain way of disaggregating revenue. However, it does provide examples on how you can disaggregate revenue. You can really do this type of disaggregation by customer, type of contract, geographical location, type of service, or based on the timing of transfer of goods or service. You just really need to think about what is going to make sense for your organization. The next area is contract balances. This disclosure is most likely going to impact only CCRCs. Amounts related to services provided to patients for which the entity has not billed and that do not meet the conditions of unconditional right to payment at the end of the reporting period are presented as contract assets. Non-refundable advance payments by a patient to a healthcare entity before the goods or services are provided are contract liabilities.
ASC 606 also requires disclosures on performance obligations. These generally would include when the healthcare organization satisfies its performance obligations, so whether it's going to be over time or at a point in time. The significant payment terms should be disclosed as well. For example, the typical disclosure today on agreements with third-party payers would be included here. Entities will also disclose the nature of the goods or services that the entity has promised to transfer. For example, inpatient, outpatient, long-term care, etc. And finally, entities will also need to disclose how it estimates retroactive settlements with third-party payers and whether those amounts are constrained. There are certain additional requirements in the standard, but those are some of the highlights of the key areas. Entities are also required to disclose the significant judgments and the changes in those judgments used in determining both the timing of satisfaction of performance obligation and the transaction price and the amounts allocated to performance obligations. And finally, there are certain disclosures that are related to cost of obtaining and fulfilling contracts.
Thanks, Priya, and thanks to Peter for providing your insights. That takes us to the end of our discussion today. As we conclude, we hope you found this conversation helpful. Please reach out if you have any questions or need assistance. Thank you for listening.
Thank you.